Welcome, everybody, and thanks for listening. Today we are speaking with Teija. And Teija, I apologize. I should have got this before. Your last name before I butcher it. How do I pronounce that?
Heikkilä.
Heikkilä. Perfect. Founder of Pet Vet M&A, Sales and Advisory. Teija's been involved in the pet care industry for decades. She opened one of the first dog daycares back in the US in the 1990s, founded National Kennel Sales and Appraisals in 2007, and has since sold over 250 pet care businesses, totaling almost $500 million. Her company specializes in helping owners of pet resorts, dog daycares, and veterinary practices sell their businesses through a structured auction process. In this conversation, we're going to explore how the M&A process works, how to maximize the value of your pet care business, and hear some of Teija's personal journey. Teija, thanks for joining us.
You bet. Thank you for that very kind introduction.
Hopefully I got all those things right. Correct me if I misspoke at all, but
my elevator speech, it was very good.
it's an impressive resume. I think the thing that I didn't realize the most, and before we jumped on here, we were just chatting that we've crossed paths many times. We're both on the circuit. We attend all the same conferences. I don't know if I've ever actually met you, so it's a pleasure to make your acquaintance on a one-to-one basis here. And I didn't realize, as I kind of read your story and dug in a little bit deeper, that you come from the industry. I just always assumed that you were the M&A guru expert that just saw an opportunity in pet care and said, hey, I'm going to go fill that void.
Yeah. Nope. Been in the industry, actually started the first daycare in 1990 in Washington State. So have been in this industry for a very long time. And even after I sold that one, I've built and purchased others and sold my last pet resorts now about 2.5 years ago. So always been on both sides of the coin, the what we call kind of the consumer facing, actually running pet resorts, as well as then the M&A side. So it's been an interesting ride throughout these years, and yeah, the industry's been good to us.
Very interesting. So how did you originally get into the pet care industry as an owner operator?
Yeah, honestly, it was just a passion. I grew up in Finland. I'm from Helsinki, Finland originally. Was trained in translating, but dogs were my passion. So when I came to the United States, I was just a hobby dog trainer, and started obviously just training dogs. And then it was the local veterinarians in the community I was living in had a emergency clinic that they were shutting down, and kind of recommended that, hey, maybe you want to take this space over and provide some services out of here. So that's how the doggy daycare started. Overnight boarding, grooming, training. I literally started like many people in our industry, totally passion driven. And then you get into the business, then you learn really fast about how to run your own business. So, but it was a very similar story than what clients who we serve now.
Yeah, absolutely. And tell me a bit, just briefly, about 35 years ago, the pet industry has changed so drastically, as you know. What was your original facility kind of like compared to things you see now?
Yeah, it was all indoor. I haven't had nothing wrong with in and out runs. I think they're probably the most efficient way to go, but it was all indoor facility. We did do communal daycare right away. And this was still back in the day when everybody was kind of freaking out about having dogs play together and yada, yada. And coming from Europe, we already had that. Dogs were way more social. People tend to congregate in parks, and dogs were playing with each other. So that concept wasn't new to me at all, even though it was, a little strange at the time here. Strange, not the right word. We just had a lot of catastrophizing. That has gone by the wayside by now. So it was still all indoor facility, multi-services, very, very dog driven. And that just came from my dog training filter that I had on at all times. So looking at things from the dog's perspective have kind of always been my driving force on the consumer side of the services. So, but obviously the industry has changed a lot. Back then, it was all flat fee for overnight, and we had daycare packages, and that was about it. And now we see these various kinds of business models. We had different kinds of facilities. We have different business models, excuse me. enhancement services that have come up, and just the consumer's relationship with their pet continues to evolve. And I think it's going to continue to evolve even from here on out. So it's just an ever evolving industry. Even though it's one of the oldest industries, it just continues to evolve, as does the consumer's relationship with their pet. And I think that's what's reflective of mainly of what we see in pet resorts nowadays.
Absolutely. And I think you were definitely ahead of your time with the intermingling of pets back in the 90s. I mean, that hardly was a thing until the 2000s. And so good for you to kind of being on the forefront of that. So
Yeah.
you operated for a period of time.
Hmm.
And when did the transition kind of happen of getting into M&A and how did
Yeah.
that occur for you?
Yeah. Again, very similar like my clients. I was probably the worst. I mean, nowadays, when I look back of what I did, I was the poster child of how you should never sell your business. So I try to prevent my clients from making the same mistakes. I was highly involved in the business outside of doing the services. I also train service dogs for people with disabilities. So honestly, I just burned the candle at both ends, which is very common when you do something that's passion oriented because you don't see it as a quote unquote job. So just working god awful hours, getting very, very, very tired. Did it for many years. And even though there's a passion in it and you enjoy it, there's a time that it kind of gets to you. And then made the same mistakes as a lot of business owners now. Even though I was very good at building a team, I never really put anybody in charge who could take care of some of the things that I was doing. So even though we had a larger team, it wasn't necessarily relieving the pressures on me. So from that perspective, when I sold my first facilities, it was just out of necessity. It's like, I can't continue going like this. Your health is affected, yada, yada. Went through the selling process, realized that there was nobody in our industry who actually focuses on pet care. Most industries have some specialty brokerage or M&A firm that just specializes in that industry. And it became very clear that we did not have that. As tired as I was of the consumer-facing services, I absolutely loved the industry. So it was a generic business broker who helped me sell the first business, and he's the one who actually piqued my interest. And he's like, "Hey, why don't you consider?" Because I was complaining that I still wanted to stay in the industry, and he said, "Why don't you consider being a broker for the industry?" So I took some much-needed time off, kind of recovered, and then started looking into that. And that's how back then the National Kennel Sales was established, just literally out of need of realizing that nobody was representing this industry. And it's nice after you sell a business, you don't need to make a lot of money immediately. So allowed me to kind of get that firm under its belt and got all the certifications that I needed and the training. And it's just been crazy ever since then. And then when consolidation started in our industry, so back then we only had private buyers who were buying, especially pet care businesses. It was, just private people who wanted what we call lifestyle properties. There's a house and there's a kennel building and you take care of dogs. So that was main market back then. So that's what we did day in and day out. And then consolidation started, and that obviously shifted. Our industry kind of got split a little bit. And certainly our firm, we went from doing maybe, 80% private buyers, 20% consolidation to 50-50. And now it's, 95% of our deals are M&A deals only. We don't do a whole lot of the private buyer deals anymore. So our firm has evolved as the industry has evolved as well.
Got it. And just a little context, you live in this and breathe this world. So just context for the listeners that private buyers are individual that just want to get into the industry. And like you say, it's a lifestyle business. They're not looking to take over the world. They just want a nice business they can make some money with. It's a great family business in many cases. And now we've obviously seen a shift to what you're calling consolidation or the private equity world. And these are larger firms that are going around and they are basically gobbling up various pet care locations and getting them under one umbrella.
Correct.
When did that shift start to happen in the industry? Do you see?
Yeah, I mean, we've had a little bit of it throughout the years, but the major shift started about 8 years ago when we started first seeing that happening. And then it has escalated. I would say the last 5 years, it has become really intense where there's more and more groups entering our market, and that interest continues to grow. So I'd say the last 5 years have been probably the most intense that we've seen in it.
Now, from a operator standpoint, how does that change somebody's approach when previously they were exiting to private buyers and now the mindset is I need to prepare my business to possibly exit to a consolidator?
Yep. The mindset should be that simply because you make a lot more money. There's no way around it. The PE market simply pays more for the same business than what a private buyer will and can. Private buyers, those transactions are pretty much dictated by SBA financing, and there's an appraisal process involved, and that appraisal process has kept the valuations of pet care facilities on the private buyer market the same for about the last 20 years. The multiplier hasn't moved the needle whatsoever.
Yeah.
And it's not affected by what the PE side pays. So that's the big shift right now. So if you have a business or what we call an asset that you can actually sell on the PE market, you absolutely should do everything possible to sell on that market because the pricing is better, the transaction, they're not easier, but you're taking away the risk aversiveness of the private buyer that often causes issues in transactions. And most importantly, PE brings in opportunities for your staff that a private buyer can't. In most small businesses, the owner is kind of the glass ceiling. And if you sell to a private buyer, that glass ceiling is just replaced by another person. But when you sell to a larger company, suddenly that glass ceiling is removed. And especially your well-tenured or your management level employees, they now have a place to grow. And I have seen actually that as the one of the biggest benefits that have come to pet care. Traditionally, we haven't had a career path, especially management and hire. We're very much a one owner, one site kind of a industry. Very few owners build several sites. Some do, but it's still a minority in our industry versus in other industries. If you do, I don't know, auto repair or oil change or whatever, you want to buy a few of them right away and have a few of them in a market. And that's never been the model in our space. So often employees, when they work for this one site, one owner concept, they don't have anywhere to go. And that was always a hindrance of retaining or even getting really good employees. And I find that has been a tremendous shift that PE has brought in, not just because of the money they've brought into the space, but also the upward movement for employees, which it's very dear to me because I find that often these people are super passion oriented. They're very good at what they do, and there's nowhere for them to go. So I love seeing that they can flourish. They can work up corporate level. They can become regional directors for these companies. And I find that personally super rewarding. And again, if you're a business owner that has a business that's even, whether it's today or in 3 years, will qualify to sell on that market, your effort should go to nothing else but that.
Yeah, makes sense. And so the ceiling's much higher with PE involved now and the opportunity's much greater. What are some things that a pet care facility might be able to do to position themselves to be attractive? And kind of what is the bar as far as who you work with? How much revenue do I need? Is there a certain number that I need to try to strive for to be attractive to a P&E acquirer?
You bet. So EBITDA, earnings before interest, taxes, depreciation, amortization, layman's term cash flow is all that matters. There's honestly no prettier way to say it. It is all about EBITDA. The more EBITDA, the better. So yes, the companies will tell a seller that they'll have a threshold of, they might even say 800,000 revenue. Most of the time it's about 1 million. What they're really looking for is EBITDA. Because if you have a facility that makes $1 million in revenue, but they're running at a 10% margin and 100,000 in EBITDA, they're not attractive despite having to hit that revenue threshold. So I'd say to even get any traction on that market where you're going to get a little nicer multiplier, you really should have a minimum of about 250, 300 in EBITDA. So we kind of use that as a gauge. Can you sell for less? Yes, but you're just not going to make the big bucks. And we're all about spend your time wisely and focus on things that will increase that EBITDA so you get more money. Everybody talks about multipliers, and there is not a set multiplier. The multiplier very much varies on how much EBITDA you have to sell, what your margins are, what your overall operations look like. So again, the teaching here is the more EBITDA, the better, and the higher margin, the better that is. And as far as positioning on that market, again, it's about EBITDA, that it's largely controlled by payroll cost, right? So two facilities, let's say they each make $2 million in revenue. One's running a 15% margin, the other one at 25%. Obviously, the one running a 25% margin is way more attractive and is going to get a higher multiplier. The two biggest differentiation on that margin in pet care is rent and payroll. Most of the time, the rent is not controllable, even if you own the business, because even if you own the real estate, because there's certain math that goes into that rent. So the controllable expense that is the only one that truly moves the needle in our industry is payroll cost. Mm-hmm. So focusing on super efficient operations, having very well-trained staff, having efficient ops just from a layout perspective. And again, this is where software, processes, all of these things come in. Those are the things that if an owner focuses on, again, keeping that payroll within control and thus increasing their EBITDA and its margin, that's how they're going to be best positioned to sell. These fire groups are looking for a business model with predictability of future cash flow at about the same level as they're buying today, because they are buying cash flow, and it's the model that creates the cash flow. So if you have an efficient staffing structure, you have proper pricing, because that's the other coin, right? The other side of the coin of payroll is revenue. So you have proper pricing. You're offering services that you can do at a cost that still makes sense, and you have very good ops in place and strong team. That's how you become attractive to that market, and again, get maximum value. These PE groups, they all want to buy a lot of facilities as fast as possible, because that's just how consolidation works. Like, you want as many horses in your barn as you can.
Yep.
So you have 3 barns to sell at some point. So yes, they will look at businesses that are not optimum. However, they just pay less for them. And sometimes sellers are like, I don't care, and that's fine. But if you're asking me how do I position myself the best, then you should really focus on building what we call a high quality asset that's attractive to many buyer groups, because that is what increases your multiplier and gets you the highest price for your business.
And how much of a track record do you have to lay down? Because maybe you're not fully optimized, and I want to start thinking about, obviously everybody wants to sell their business someday. And when I start trying to optimize my business, how far back into the past are PEs looking?
Yeah. So financials, we provide 3 years. I will say what we call TTM or LTM, trailing 12 months or last 12 months, counts the most.
Yeah.
So yes, you can make operational changes, run it for 12 months, and you're going to get a better price. However, they do look at historical financials for trending, right?
Yep.
So 3 years is what's provided. Majority of the focus is on that TTM, the last 12 months, with the last fiscal year being the second most important. So those are kind of the periods to focus on. But I also say, we have this saying that, you should run your business today like you're going to sell it tomorrow. Like, we often get asked, like, how far in advance should I start prepping? There's businesses that can be on the market in 30 days. Like, it doesn't take years and years and years of prep to go on the market. If your financials are in proper order, you're running your bookkeeping correctly, you have a team in place, you have efficient operations, you can go on the market anytime.
Yeah.
And life happens, things happen in people's lives, whether it's somehow a forced sale, or there's opportunities that come up. Like, company calls and says, hey, we just bought your competitor, we really want to buy you. You want to be in a position to take advantage of that. So if you're running your business today like you're going to sell it tomorrow, you're always optimizing it at any given time, and you don't have to have these big preparation periods, if that makes sense.
Makes total sense. And I just want to circle back quickly to something that you were touching on. Payroll. What would you consider acceptable % of revenue for payroll that you should target or aim for?
Yep. It's the $1 million question. It depends on your rent a little bit, but leaving that out, honestly, if 40 and under, and this is all in, including your taxes, fully burdened, excluding the owner. We sometimes have to make adjustments to that, and without nerding out on how to do the math, everybody should strive for under 40%, 35 even better.
Yeah.
Right? You want to look at your business like it's a pie, right? And there's slices in the pie. And you really want to have a nice profit margin should be a slice of it. So if your payroll takes 50, or nowadays we've even seen 60% in payroll, and let's say your profit margin goal is 25%. Let's say you have 50% for payroll, leaves you, 50 plus 25 for profit, 75, leaves you 25% for your rent, your owner wages, your repairs and maintenance, your advertising, everything else. You just run out of pie, right? And that's the reality of payroll. Like if it takes a huge piece out, then there's nothing left, and it always eats into that profit pie. And we see plenty of really high quality facilities running at 32, 35, 37%. It takes work in staff training and efficiency, and again, pricing. We don't talk enough about how we should be pricing our services so that your payroll can be at this level without compromising ever the pet care or the customer care. So but that would be a number. I would say anything below 40% is good and desirable.
Got it. Okay. So talking about pricing, when you get engaged with a particular pet care facility and maybe you just do a cursory assessment and maybe they're not ready per your kind of initial review, do you offer guidance on looking at their pricing, or do you pass them off onto somebody else and say, hey, you guys need to optimize a bit, or how does that look? What does that look like?
Yeah, so we do lots of analyses on businesses, whether they're ready to sell or not, or people just kind of want to know what their baseline is. And that analysis is way more than just establishing this is what your business is worth today. We actually look at the overall picture. So yes, if their payroll is inflated, the next thing we do is it a pricing issue or is it just inefficient operations? And we provide guidance on that. So we do what we call a 360 analysis on the entire business, so people know exactly at the end of that analysis what they need to focus on. So if we determine that their pricing is incorrect, we don't get into the let's price and how to teach your staff to sell. There's plenty of consultants who are way better at that than we are. But we are good at pointing out this is what you need to focus on. Often business owners focus on things that they like, and they often neglect the harder business side of things. And so we will say, if you're going to run this business for the next 12 months, focus on these 2 items, and that's it. Let everything else go away. These are the 2 items that will move the needle on you making a lot of money on a sale or not being able to sell at all. And then we provide guidance and also referrals as to where they can where they can go to get that. And pricing is certainly one of them, because we're really good at figuring out what market pricing is and how much that business is charging and how much they maybe should be charging. Or it could be that they need to eliminate some services because they simply can't afford to provide them. There's a lot of movement toward having these menu offerings for customers that, 20, 30 items long. And at some point you need to kind of look and say, okay, let's just focus on the one that the market actually wants. Mm-hmm. Market being the consumer, and let's focus on the ones that we actually make profit on. And sometimes it takes outsiders to do that analysis for an owner.
Makes sense. We run into that quite often on the software side, where people come at us with this huge laundry list of services that they're providing, and it's like 80% of the time, you're selling these items, these 20% of the items, and so you can really become, I think, more efficient by, less is more in many cases.
Absolutely. I'm a big believer in the KISS model, and I believe that most nowadays, especially if I just look at consumer trends, not just in healthcare, but anything to do with consumer services, the times of complicated pricing models or non-transparent pricing models, they kind of gone by the wayside. I mean, I know that in my own life, if I When I go buy something, I want to know what it costs because it comes into my decision-making process. And keeping it simple often is better than having all of these offerings. So I completely agree. And again, it often takes somebody like yourself or us that says, okay, you have way too many offerings here. And like pare this down, figure out what they actually want to buy and how you sell more of that so your profit margin stays strong.
Yeah, particularly with Goose, it oftentimes is a forcing function when you start putting your services and viewing your pricing in an online booking engine.
Yes.
It's like, guys, this needs to simplify a little bit or the consumer cannot consume, right? If they are confused, they just abandon shop and they're gone.
Absolutely. They just move away. I couldn't say better. I could 100% agree with that.
So what is you mentioned the 360 evaluation. What's a timeline for something like that? How long does it typically take once somebody engages you and that goes through the process?
It's super fast from our perspective. Honestly, the biggest timeline is how long it takes people to get their financials to us. But from the time we have their complete financials that we need, it takes us about 2-3 days to process them. We have clarifying questions. So about a week for us to process, again, depending on the customer's response time. And then I have a meeting with them after that. So under 2 weeks altogether, as long again as we get answers. We move very fast here. This is all we do. So we're a little bit of a well-oiled machine. So as long as people are responsive and get us what we need, we move through it.
That's amazing. I was expecting much longer timeline than that. So
it goes pretty fast.
That's fantastic.
Yeah. We have the systems and spreadsheets in place.
So without getting too deep in the weeds and nerding out on the data, what you said, as long as they get their financials to us in a timely fashion, what are I know this is probably a loaded question, but what are the financials that they need to pass over to you to be effective?
We start out pretty easy. It's tax returns for the last 3 years and P&L statements and balance sheets just to kind of see if that is going up or down or sideways. That's the initial one. An income breakdown. Sometimes it's in their P&L statement. Sometimes it's in their operational software, depending on what they're using. Those are it's nothing too complicated to start off with. And then once we've learned that every accountant and CPA, they kind of lay books out differently. We don't have a cohesive chart of accounts in this industry. So once we get that, we kind of understand how they're laid out, we put them into our system, and then we send a lot of clarifying questions. We do understand that business owners have a lot of personal benefits embedded in the business expenses. So those are the questions that we will ask about. So we truly understand the entire benefit that the business provides to that owner in various ways. So we get the EBITDA, but the starting off is simple. It's tax returns and it's P&L statements, and then the income breakdown, then we go from there.
Yeah, and you just mentioned something that I have been just yearning for so long: standardization and standardized chart of accounts. Do you think that's becoming more of a thing with PE getting involved? And they obviously probably have a pretty standardized way of looking at business.
I don't see it on the business side at all. Obviously PE, yes, because they want all of their sites to run on the same one. We at times we take on clients where we literally meet with them every month until they're ready to sell, because they just want somebody to guide them through and do a monthly analysis and make sure that they're hitting their EBITDA goals. And in those cases, we create their chart of accounts or recreate them, because it's the chart of accounts and the P&L statements, they're like a book. They read the story, right? And I often get asked, like, so what's one of the biggest mistakes people who want to sell make? And honestly, the biggest mistake they can do is respond to the call, we want to buy a business, send us all your financials. Number one, like you're like, I always call it, it's like showing your home to a prospective buyer the day after you had a frat party.
Yeah.
Like it's just a disaster, because I will say 90% of the financials that we get, we will clean up somehow. They're miscategorized, or 1 year expenses, certain expenses were booked under one category, now they're booked under another, and it causes inconsistencies in financials. Any inconsistencies are a risk factor. Risk factors will overprice, and that's just the fact of life. So the financials really tell the story of the business and how it's run. And the cleaner they are, removing personal crap out of there or identifying it clearly, making sure that everything's being recorded in a consistent manner throughout the last 3 years, those all have an effect on the story that you're telling and how attractive that asset becomes on the market. So it would be lovely if everybody could use the same chart of accounts, because then there'd be consistency in reporting. But we see all kinds of stuff. And the financial reporting in our industry is probably the biggest issues I find on the business side that we have. And most owners don't pay a lot of attention to it. They do what their bookkeeper tells them to do. And there's good bookkeepers and there's horrific bookkeepers. And so then when you get the story and you're reading it and it just looks like crap, just simply because how it's put together.
Yeah.
And then we get in, we clean it up, we standardize it, yada, yada. And suddenly the story is a whole lot prettier. So that's kind of my story. So I echo you. If we could do a push, have a chart of accounts that everybody uses, I'd be all on board.
Do you by chance have a preferred published chart of accounts that you have
We
out
don't
there?
have a published one, but we do have one for pet care, yes.
Yeah, maybe you should share that. I think the industry would love to kind of see like what does good look like. And
I'd be happy to. I mean, I think it's actually a good project that would have a big impact because it's not too difficult for bookkeepers and CPAs to redo a chart of accounts. And again, from a selling perspective, it just, the story needs to read well. So
Yeah.
you can certainly explore that a little more.
Cool. Tell me about just operationally. I see a lot of businesses, and it's hard to find a business today that isn't all core services, meaning boarding, daycare, grooming, training. Does the diversification matter in a business, or tell me more about how you think about that?
It matters a lot, especially after COVID. We realized how risky if all your eggs are in one revenue source. And specifically in COVID, if you were boarding only, you were toast, and you were toast for a very long time. So we really realized it's like anything else, like all of your investments should not be in one stock, right?
Yep.
So it's the same thing. Diversification has a big impact. Majority of revenue, and I'm speaking from PE because that's mainly who we work with, they want most of it in boarding and daycare. Boarding a little higher than daycare. Daycare is much more sensitive to consumer spending. So it has a little bit more, flex going in and out and has more competition nowadays and yada, yada. But those are the two primary revenue drivers. Grooming has become a very accepted revenue source. We used to run away from it from the key person dependency, but especially facilities who have more than one groomer. So the risk is not with one person. Those are good revenue streams to have. Training is really on how it's structured. Again, when I talk about key person dependency, if there's one person in the business who literally generates revenue, whether it's one groomer or one trainer, the risk becomes if in a sale, that person just suddenly says, well, I don't want to work for these people, and they leave. So there's a chunk of money that goes with them. And the buyer evaluates that that's a huge risk factor. So the more if you offer these, what we call kind of specialized skill level required services, mainly grooming and training in our space, if you offer those to dilute the risk factor component of that key person. So having more people involved in it, separating grooming from bathing, anything where if somebody leaves, you're not losing any money, that would be the risk prevention, I guess I would do on that. But again, going back to diversification is super important. Everybody should have it. And boarding and daycare should be the two main revenue drivers.
Got it. And in many of those cases, there is key man risk for groomers or trainers. Are P&E firms penalizing for that or discounting the EBITDA in those revenue streams?
A little bit. It depends on the situation. If we have a facility that has a solid grooming department of 6 groomers, that's not a problem. One leaves, so what? The rest 5 are going to pick it up, right? So that's less. If it's one groomer, that is an issue. And often we will either see a discount on the EBITDA for that, because obviously, especially grooming is also a lower profit margin revenue stream. So we'll see a little discount, or we do some contingent plans like, hey, we'll pay you, 90% at closing. If the groomer stays on for another 2 years, you get the rest 10%. So there's risk sharing mechanisms that come into play in a transaction, whether it's a key person dependency or some other issues. I mean, there's plenty of other issues, not just of these two people that might make the company a little leery, but they want to share the risk with the seller. But again, if it's a robust department, say training, and you have several trainers or you have staff that's trained and you specifically don't do any specialized training, no aggression, no nothing like that, typically, if you have several people doing it, it's not a big issue. But if it is relying on one or two people, and especially if it's relied on the owner, then that becomes an issue for sure.
Absolutely. And speaking of the owner, what are the expectations and what do you typically see as far as passing the business or the asset to the new owner, whoever that may be, oftentimes a P&E? How long does old ownership need to stay with the business? Typically, what do you usually negotiate there?
Again, depending on the strength of the business. So my ideal business is that I can tell the buyer group that this business is so well run, has a strong management team in place. You can call my client for a couple of weeks post-closing, but you don't need them. That is the ultimate business that will get the highest valuation on the market, because that's what everybody is looking for. They're looking for that business that's run so well with such level management that the owner just acts as a big CEO that kind of just provides oversight. So that's the ideal case. Other owners that are more involved, yes, and it is then evaluated on a case basis. Overall, there's one or two companies in our space right now that will offer the owner sometimes to stay with the business. Not every time, but sometimes they're like, hey, if you're not really done working yet and you want to stay on board and help us grow the brand in the area, we'll retain you basically as a GM. So some cases that happens. Most of the companies, they expect that owner to be gone within a couple of weeks post-closing. And again, it's the strength of the business that's evaluated, right? Because there's, you can't sell the owner, right? So if the owner is still really important to the business, it's probably not going to attract a lot of attention or high valuation in the first place, because they really focus on companies that can run and have a model that supports itself without the owner's direct involvement. But owners typically leave within a couple of weeks post-closing. And a private buyer deal, they typically have to give 80 hours and then they're out of there.
Okay. Makes sense. And then for the key employees, they are obviously incentivized typically from private equity because they're getting additional benefits in many cases.
Bingo, they're getting additional benefits. Sometimes, I mean, we've sold businesses where a client has super long tenure stuff, like they've been there 10 years, they're well beyond a GM, they're just super good people, and they actually get pieces out of the pie, out of the sale, but they normally wait like a year afterwards.
Yeah.
So the people are incentivized to stay with the buyer group and get to know them and kind of find their own way within that company, and then they get their reward about a year after. So there's many different ways to reward, and just depending on the relationship and whether it's the buy side who does it or whether it's the seller who just wants to show appreciation, because these people help them build this business that they're now making money out of.
Got it. And obviously most of the emphasis is on EBITDA and a multiple of EBITDA, but are there any other intangibles that folks can do to help their cause?
Yeah, and that's it all flows into EBITDA, right? I always say it's like your business is like a funnel, right? On top of the funnel, you have your marketing, your location, your facilities, your pricing, your offering, your reputation, your Google reviews, yada, yada, yada. Everything goes into the top of the funnel, right? And then at the bottom, the EBITDA gets spit out. So everything that you do here affects that EBITDA and how much comes out of that at the bottom of the funnel. So obviously having really good operations, and this is where I believe that our software continues to improve, because I find that could be easily the core of the business where the efficiencies are actually realized. Whether it's staffing models that are built within it, whether it's efficiencies in how people can run a quick report, do what they need to do, minimizing mistakes, especially minimizing mistakes in where it matters, meds and those kinds of things. But having this core system that forces people to think through their operations and making task lists and yada, yada, just again, payroll reduction, right? Or keeping it within control and making the ops super efficient, and really strong teams. Having a well-trained, motivated, strong team reduces turnover, makes the business better run. Your clients love it because they see the same people, hopefully happy every day. And those are the things that also alleviate stressors on owners, because we often, especially in conferences, people are tired. They get tired because they feel like the only way for the business to grow is for them to work harder. And a lot of them are like, I'm already putting in 60 to 80 hours. I can't work any harder. And this is where that full smarter piece of working comes in.
Yeah.
And having very strong team and hiring good people. And sometimes, I mean, I'm pretty blunt about it. Like, if you're not good at hiring, hire a company to do that for you. Like, find a very good general manager who either comes from hospitality or childcare or some comparable industry, and let them run with it. So then that releases some of those tiring duties of the owner. But these are the intangibles that owners can structure their business that alleviates their current stressors. I mean, we've had people who call and they're like, I'm done. You know, the groomer walked out yesterday. I'm just tired. I want out of here. And then we go through the entire analysis and I'm like, you know what? Super nice business. Could be even better. You're leaving money on the table, blah, blah, blah. And then they put strong team in place. A year later, they're like, no, I'm going to keep on cruising. I'm making good money. I'm not working too hard, and call me in 2 years. You know, so magic happens when you do these things. So again, you know, going down the rabbit hole here, but it really comes down to structuring that really strong team where the intangibles also start happening, and that at the end of the funnel, what comes out is meaningful EBITDA. And when you turn everything else that goes into it together, and you get a higher price at that point. Obviously everything that goes into that is your reviews, your customer management, how you handle your conflict, you know, your facilities, the cleanliness, good inspections. I mean, all of that stuff plays a role in that business model and how it turns out that EBITDA.
Yeah. And like you just said, like the intangibles ultimately end up as your EBITDA. Like that's the bottom line that everybody's kind of shooting for. So I guess that makes total sense.
Like the blender, right? You put all your protein things, you put everything in, you push the button, boom, that's it. And that's why there's never one thing. I mean, the biggest thing is obviously payroll control, but that can be achieved by many ways. Is it pricing? Is it this? Is it that? Whatever that is. So that's the best way to explain it. Like, it's that entire model and what you put in that blender and how you push the button, what comes out.
Got it. So tell me, what's next for you? Do you ever see a deal come across your desk and you're tempted to get back into the owner-operator side?
Well, I do. We see some deals that come through, especially if it's a larger company that's divesting some assets that aren't working for their portfolio anymore. And there's typically really nice facilities and footwear reviews that it's not in their core geographic area anymore. I'm like, oh, I should pick that up. But then I just remind myself as well, there's only so many hours of the day. So far, I'm just kind of sticking with the brokerage, but I'm very, very tempted often, I will say that, because there's some really good deals out there at times that anybody with a good business sense and some energy can make a buck on. And I tell people, like, where's the best opportunity in pet care right now? It's in those underperforming assets that don't have any structural issues. Like, their zoning is good, they don't have a horrible reputation, yada yada. I mean, you know, good bones and no structural issues. Those are the ones that people should pick up, because you can get them pretty cheap and then build them up and sell them to PE. That would be the. So yes, I'm very tempted. And then my sanity comes in. I go home, I have a glass of wine. I'm like, okay, I could not do this. And the wine wins. So
yeah, let's stay in our lane, right? Yeah.
Yes. Exactly.
So we obviously know a lot of the private equity groups in this industry. There's many that are just keep emerging and growing. I know it ranges, but what can a typical pet care facility expect from a multiple?
Yeah, it ranges tremendously. I'm always very leery of throwing these numbers out, because all anybody hears is the top line, and they don't realize nobody really knows how their business stacks against others, right?
Yeah.
And it's very different being in your business and your clients telling you every day how incredible you are and yada yada, versus suddenly being an asset on the market against other assets. Huge difference. So very leery. I will say, of the private buyer market, your lifestyle businesses, you know, they still have to generate a certain amount of cash flow to even be sellable, but that multiplier hasn't changed. So it's going to be between 2.5 to 3, maybe 3.25 if it's something good. And that just won't change and hasn't changed because of the SBA financing process. So that's there. On the BE market, it really depends on how much EBITDA you're selling. I mean, a facility at 250, 300 EBITDA, you know, maybe you're going to get a 4.5, 5.25. And then you go to, you know, 500,000 in EBITDA, it gets a little more exciting. Over $1 million in EBITDA, it gets more exciting. And where it gets more exciting, and again, I can just speak for our process, is the more EBITDA a business sells, and if it's put through a structured process to the market, everybody can see it at the same time, right? And you're creating a sense of competition. And that's how your pricing goes up. If you just deal with one company alone, they pretty much control what you're going to get. So that's why we're big proponents of go on a structured process, get on the market, because there's few and few pet resorts that generate high amounts of EBITDA. And when that goes on the market, more companies want it. And it's the competition that actually increases the multiplier, right? Versus just with one. It's just like having a hot car that many people want it. Like it's just going to fetch a higher price than just selling it to a neighbor. So that's the process that we take facilities through. So anytime, and again, if you get into over the millions, especially if the single site making that much, you're going to get well past that 5, 6, 7 point up from there.
Yeah, that's awesome. And then
Competition that dictates it. It's all about the competition. As long as you're just dealing with one company, they hold the cards in how much you're going to get paid.
exactly, right? More people
Sense.
more people that are interested, it really drives the price up if they think somebody else is going to swoop in and steal the deal from them, right?
Bingo. And again, it's we always call it the attractiveness of it, right? And in our space, we have a lot of nice assets. Then we have a few that are extraordinary, and it's the extraordinary ones that they just really shoot themselves in the foot if they don't allow to be exposed to the market and kind of see what the best thing is, because that they tend to go for much higher valuation than the kind of your run of the mill ones. And nothing wrong with them. There's always plenty of them, but you know what I mean on that.
Makes a lot of sense. So, in closing here, I know we've taken up a lot of your time, but let's wrap it up. And you said it earlier. I think I know what your answer is going to be. But what advice would you give to pet care operators that are thinking about selling? Or obviously, maybe not everybody has selling on their mind, but what is a good piece of advice for anybody operating in this industry?
Whether you have selling in mind or not is not the point. If you run your business, again, like you're going to sell it, you're just going to run a more profitable business, which today means that you will have more money in your bank account. I mean, it never should be that, hey, I'm going to start running a good business when I decide to sell.
Right.
No, you should run a good business today because it affects your personal financial health and your families. So, having that mindset, because then it also enables you to, again, take advantage of opportunities or sell at any given time, right? But the main things, again, because it comes down to that EBITDA, is making sure your pricing's on par with market, offering the services that your consumers are actually wanting to pay, keeping your payroll in control and taking advantage of all the efficiency tools, mainly software in various ways, that are out there. And every time you make a bigger business decision, run the math through and say, will this increase or decrease my EBITDA? If it increases, great, go for it. If it decreases, but it's something you would like to do because you like it, I will probably say no. And keeping things simple. I mean, it's very easy to get too complicated with our service offerings because, consumers ask for anything, right? You have one consumer asking for everything under the sun, and then you have that, A/B list menu. So kind of keeping things simple and focusing on what actually matters in your business. But the main thing I would try to get away from, I'll start running my business well when I'm ready to sell.
Makes a
Get
ton
rid
of
of that
sense.
mentality. Just run it every day like it was sell it tomorrow.
Love it. So, Teija, thanks so much for joining us today. You are a wealth of knowledge. I look forward to seeing you in person at the next conference we attend, and we'll have to catch up then. But until then, thanks so much.
Thank you. Appreciate it.
That was great. I really
Bye.
appreciate your time. That I think is super helpful for just the common operators that, just want to get a glimpse inside of what that process looks like.
Yeah, I appreciate it. I mean, I've been in this industry a long time, and I've been very happy that I do see improvement. Like way back when we didn't even talk about EBITDA, we talked about sellers' discretionary earnings, and like people have no clue about selling valuation, yada yada. And we still run into that because people just have misconceptions. But I think overall the business sense in the industry has increased, but there's still way too many that are not running it the best. I mean, I always say like you have so many hours a day and you can choose how you spend it, right? So, spend your time like you're going to build an asset versus just, having a dumpster fire that one day you just have to walk away from.
Right.
So that's all. I can talk about it forever, so I'll stop now. But yeah,
I love it.
I appreciate the opportunity and it is super important for our industry to hear.
I think
We have a
so
lot
too.
of action-oriented people. They lead their business with their heart. They can lead with their heart and their brain and make more money.
Yeah, for sure. And I didn't want to get into it on the recording or the meat of the conversation, but how much does software, what areas can we help in really?
Really good reporting. Like, I'm not kidding, and I will not name any companies, but like, we always run occupancy charts for all of our listings because PE wants to know usage, right? Because it's not just about revenue. You can increase revenue by increasing your rate, and suddenly you lost 20% of your clients. And so, I mean, even yesterday, I was like, this makes no effing sense. You're running these reports, you're trying to figure it out, and we're pretty good here. We're nerdy outside of everything. We live in spreadsheets.
Yeah.
And it shouldn't be this difficult. Like, people should get their matrices, nice reports that show them exactly what their usage is, what it was compared to last year, what their pet per night fee is it going down, is it going up, yada, yada, all this kind of stuff. And I also love the more, because of the newer generation, they are very software focused. So the more that can run through that, I mean, I compare it to vet hospital because they have, I mean, it's actually practice management software, right? We tend to use ours for checking in, checking out meds and food and belongings, right? That's kind of core usages. So getting for the owners better reports where they can actually track the stats on the business, and B, running as much as possible through the software where the employees are motivated to use it. Like, even if it's daily checklists, like, and we literally do time studies in facilities when we're looking at their payroll, and they're like, this is how long it should take to, clean a suite.
Yeah.
So having those kinds of things incorporated into the already existing software as much as possible. So you affecting labor control through it. So those are kind of, so on one side, it's the stats and just getting them 100%. If I run 3 different reports, I should get the same number if it's supposed to give me the same number versus a different number.
Right.
And make some of these things easy, knowing that the owners sometimes need easy numbers. And then the other side is really making more of a facility management software where a lot of things run through this that owners can use to control. And again, labor is such an issue.
Like daily operational metrics that you can just tap into. Yeah.
Exactly. Yeah. And I know it's sometimes outside of, because we look at, it's called reservation software for a reason. It is for reservations, but I just imagine that it could do so much more. And maybe we could then get people to use it. Like, now, if I send people to an engineering company, they do a time study. Now the engineering company is going to sell them software, how to trap all this. And I'm like, well, that should be in all of our ops software already, right? And there's an opportunity for you guys as well. So that's how I say, because people are piecemealing this again.
Yeah.
The people who really want to run good businesses, they do this, and then they have these piecemeal softwares that they're trying to complement within it.
Cool. And I think that's definitely the direction that Goose is aiming from is, A, we want to help you increase revenue. We want to goose your revenue. And B, operationally, how do we drive more efficiency into your operations? And
Period. Love it.
those are two main pillars of what we're kind of building on our side that we definitely have focus on. But we see it
Yeah.
as we're migrating from other platforms, and the reports or just the data itself is just really hard to get at. And my
And it's sometimes I would like, I've done this so long that I'm like, that doesn't make sense. I can't pinpoint why, but something doesn't make sense.
Yeah.
And then you start digging in it. It's like, it's rubbish. Like, a dog is double counted in occupancy if it leaves at night. Or, something. I mean, I see so many crazy. It's like you have to know every software system and how the numbers are calculated so that you can, and it should not be that difficult, in my humble opinion. So that's one side, because I think our operators would track more data if it was easier. They don't want to nerd out. They don't want to hire outside people to take this data and, 1,000 pivot tables later.
Yeah.
Right. They might actually use it. And then I do think, like, again, going to the task, because that's the labor piece of things. What I see, especially the task management, and the time management, I mean, it's clunky software. It's just ugly. And I'm like, this could be better if it was already in a modern platform that we're already using in our facilities. And there again, I think more people would use it. And maybe it's a different module and people pay for it, whatever.
Yep.
But I do see a lot of opportunities there. So, you ever want to pick my brain, just let me know. I'm super passionate, especially about the labor control, because it's not about cutting heads. It's about running your business super well and having the revenue side in there.
Makes sense. Makes sense. Well, cool. I've taken too much of your time already. I'm going to let you go. I really appreciate it. Take care. Thanks so much, Teija.